Next question. Reliance Limited is coming with an issue of debentures having face value of rupees 1000 at 12% coupon rate. The term coupon rate stands for rate of interest. Income tax rate is 35%. Calculate KD, cost of debt financing, if it is issued at par value, and with that the second and the third questions are given. I request all of you to go through the question, please. So friends, over here the question is not providing the information what is the time period for which the security is issued. So we assume that the security is issued for perpetuity. So write an answer. Assuming that security is issued for infinity, comma, KD, cost of debt, is calculated. Dear students, for perpetual security, we know that there is a formula like this: P0 is equal to A1 divided by I. This is what's the formula for perpetual question. If at all for perpetuity, the amount is going to remain same. So we can say that I is equal to A1 upon P0. The term I will be replaced with, like we understand, cost. It is interest into 1 minus tax rate divided by P0 stands for the amount, and that is the way KD, cost of debt financing, is calculated. Logic is simple. Numerator is indicating the cost that we are going to incur, and denominator is indicating the amount that we have received. So answer of the first part of the question, in which we understand that say the security is issued at face value. We'll make the calculation like this: 1000 into 12% into 1 minus 0.35 whole divided by 1000. So 12% of 1000 is 120 into 0.65 divided by once again 1000. 120 into 0.65, 78. So that is a cost of rupees 78 for using an amount of 1000. So the cost is 0.078, that is 7.8%. I request all of you to write an answer for the first question for cost of debt financing. You may write this too, or you may write directly answer from KD as you wish. Second part of the question. What is the KD if the security is issued at a premium of 10% and there is a flotation cost of 5%, like that information is given. So dear students, over here the answer for cost of debt financing will be calculated in this way. I request you to pay attention. It will be found as interest into 1 minus T divided by amount. Face value of the security is 1000. Rate of interest is 12% into 1 minus 0.35 whole divided by 1000 plus 1000 into 10%. Why? Because the security is issued at premium. Of course, we understand that say anytime the issue of the security is at premium or discount, that premium or discount is calculated on face value. So it is 120 into 0.65 divided by 1100. So it is 120 into 0.65, that comes to 78 divided by 1100, that comes to 7.09 percentage. This is the way we compute the answer. However, we can see that the flotation cost information I have not considered. Now, flotation cost is an expense, but its nature is that it is one-time expense. It is not a recurring expense. So the way we incorporate the flotation cost in the calculation is like this. We deduct the flotation cost from the denominator. That is 1000 into the flotation cost rate is 5%. So what will happen, dear students, over here, say it is 1100 minus 50. So what will happen? It is 78 once again divided by 1050 divided by 1050 into 100, that comes to 7.43 percentage. This is the way we make the computation of the answer. This is the way we are required to incorporate the effect of the flotation cost in the calculation of the cost of debt financing. As it is one-time expense, it is deducted in calculation of the amount that we have received from the investor. This is technically the issue price, and this is the flotation cost. Regarding calculation of the flotation cost also, that is a small ambiguity that we have. Number of times it is calculated on the face value, and number of times it is calculated on the issue price, that is 1100. Most of the answers have the suggested answer in which it is on the face value, so accordingly I take face value. Unless it has been given that the flotation cost is required to be calculated on the issue price. Please write down answer. Thank you.